Welcome to Earthquake Insurance 101. This is one of the most important and most overlooked conversations you will have with California homeowners. Unlike auto and home insurance, earthquake coverage is not included in any standard policy. It must be purchased separately. And in California, with over 500 known fault lines, the risk is real and the exposure for clients who don't carry it can be devastating. Today we'll cover what earthquake insurance is and why it matters, the three core coverages, key terms, rating factors specific to California, discounts, and myths. Many of today's slides are marked for your live whiteboard session because they're critical to address with clients. Let's build your foundation. The single most important thing to establish up front is that earthquake insurance is not part of a standard homeowner's policy. It is always a separate purchase. Clients assume it is included, it is not. When a covert earthquake occurs, a standard homeowner's policy pays nothing toward the structure, the belongings, or temporary housing. The client is entirely on their own without a separate earthquake policy. In California, the two main options are the California Earthquake Authority, the CEA, which is a publicly managed state-backed insurer offering standardized coverage, and private carriers who may offer broader options, lower deductibles, or policies bundled with homeowners. Policies are 12-month terms, not required by law or lenders, but should be a standard part of every homeowner's conversation in California. Know your carriers and what they offer before you quote. A CEA earthquake policy, and most private policies, covers three things. Dwelling, coverage A. This is the most important one. It pays to repair or rebuild the structure after a covert earthquake. It should match the dwelling limit on the homeowner's policy. If the homeowner's dwelling is underinsured, the earthquake dwelling limit will be 2, personal property, coverage C. This covers the client's belongings. Start the conversation at $5,000 to $25,000 depending on what they have. If they have high-value collections, electronics, or jewelry, those may need to be scheduled. Loss of use, coverage D. This pays for temporary housing and additional living expenses while the home is being repaired. After a major California earthquake, displacement is often measured in months, not weeks. Always recommend the highest available limit. This is often the most underappreciated coverage until clients actually need it. Your trainer will walk through real examples of each coverage and what a claim looks like in the live session. These are the core terms you will use in almost every earthquake insurance conversation. A few to emphasize: the deductible is percentage-based, not a flat dollar amount like auto or home. That is critically important to explain up front. A 10% deductible on a $600,000 dwelling means the client pays $60,000 out of pocket before the policy kicks in. The next deductible up from there is typically 15%. This would make for a $90,000 deductible, which is $30,000 higher. Make sure clients understand the real dollar amount, not just a percentage. The CEA is not a private insurance company. It is a publicly managed state-backed entity. That matters for how claims are handled and what coverage options are available. Liquefaction is a concept many clients have never heard of. It is when saturated soil loses its strength during a quake, essentially turning to liquid. Homes can sink, tilt, or be destroyed even far from the epicenter. Retrofit is a selling point and a discount trigger. Clients who have had their home bolted to its foundation and cripple walls braced may qualify for lower premiums. Let's pause to discuss these terms in more detail. Earthquake insurance has fewer discounts than auto or home, but the ones that exist can meaningfully affect the premium. Retrofit is the biggest discount trigger and the most underused. Many California homes, especially those built before 1980, have been retrofitted by previous owners without the current client knowing. Always ask, and if they are unsure, suggest they check with their contractor or city permit records. New construction homes built to current seismic codes are rated as lower risk. Year built is one of the first questions in the rating process. Multi-policy discounts are not usually available on earthquake policies. They apply more sometimes when the client is using a carrier for both home and EQ. Always check what applies at quote time. Construction type discounts vary significantly by carrier, so know your carriers and what each one rewards. Earthquake premiums are determined by a combination of factors, many of which are location-specific and unique to California. Distance to the nearest active fault is one of the primary drivers. The closer the home is to a fault, the higher the expected shaking intensity in a seismic event. Soil type matters enormously. Homes built on sandy, loose, or waterlogged soil have a much higher risk of liquefaction, which can cause total losses even at significant distances from the epicenter. Construction type is a major factor. Soft-story buildings, multi-story structures with a weak first floor, often seen in older apartment buildings, are among the most vulnerable. Wood frame homes generally perform better than unreinforced masonry in a quake. The deductible selected has a direct impact on premium. A client who moves from a 10% to a 15% deductible will see a meaningful reduction in cost, but make sure they understand what that deductible means in real dollar terms before they make that choice. All 7 myths are marked for your live whiteboard session with your trainer. Here is brief context on each so you know what's coming. Myth 1. Homeowners covers earthquake. The most common and most costly misconception. Standard homeowners policies universally exclude earthquake. Period. Myth 2. Only matters near a fault shaking, liquefaction, and landslide can cause severe damage well beyond the fault zone. Many of the most costly losses happen miles from the fault. Myth 3. Too expensive. CEA policies are often more affordable than clients expect, especially on newer or retrofitted homes. The cost of not having coverage after a major event is incomparable. Myth 4. Government will pay. FEMA disaster assistance, assuming a homeowner could qualify, would likely only cover some of the temporary housing costs and loss of essential items. The homeowner would still be responsible for rebuilding. Myth 5. Only older homes. Newer homes are built to better seismic codes, but they are not immune. Soil, location, and the magnitude of the event all play a role. Myth 6. Condos/renters don't need it. Renters need coverage for their belongings and loss of use. Condo owners need dwelling coverage for the interior of their unit in their personal property. The whole master policy may not cover individual units. Myth 7. Flood and EQ are the same exclusion. They are 2 completely separate exclusions requiring 2 separate policies. Flood is covered by NFIP or private flood carriers. Earthquake is covered by CEA or private EQ carriers. Neither covers the other. This is one of the most important conversations you will have with California homeowners, and your trainer will walk through real claim scenarios to bring it to life. Rebuild costs in California are among the highest in the country. After a major seismic event affecting a wide area, demand for labor and material spikes and supply chains are strained. Rebuild timelines and costs can far exceed pre-event estimates. The FEMA myth is worth repeating here. After a declared disaster, FEMA assistance is primarily low-interest loans. Homeowners who do not have earthquake insurance are borrowing money to rebuild their own home and paying interest on it. The percentage deductible point is critical to make concrete. Walk through a real example with your trainer. On a $500,000 dwelling with a 10% deductible, the client's responsibility would be $50,000. On a partial loss that totals $80,000, they cover more than half of it themselves. Liquefaction and landslide are important to explain because clients assume distance from the fault equals safety. It does not. Soil type and topography create significant exposure well beyond the fault line itself. These are the recommended benchmarks your trainer will walk through live with real dollar examples. Dwelling. Always match the homeowner's policy dwelling limit. These 2 policies must work together. If the HO dwelling is underinsured, the EQ dwelling will be 2, and the client will face the same shortfall at rebuild. Personal property. Carrier defaults are typically $5,000 to $25,000. Make sure you are selecting limits based on what the client actually has and/or cares about. Loss of use. Always recommend the highest available limit. After a major earthquake affecting a large area, rental inventory disappears and costs spike. Clients who assume they will be back home in a few months may be displaced for a year or more. Deductible. This is the most important thing to explain clearly. Walk through a real dollar example every single time. Do not let a client choose a higher deductible to lower their premium without fully understanding what that deductible means in dollars. CEA versus private. Know what each carrier offers. CEA is state-backed and standardized. Clients who want the lowest possible deductible or broader coverage terms may be better served by a private carrier. Let's review for a moment. This activity applies what you've learned to real client accounts. Question 1. Does each client have earthquake coverage? This is the baseline. For clients who don't, this becomes your cross-sell conversation. For those who do, note whether it's CEA or a private carrier. Question 2. Deductible in dollar terms. This is the key skill reinforcement from this session. Given the client's dwelling limit and their deductible percentage, calculate the actual out-of-pocket amount. Make sure agents can do this quickly for any client. Question 3. Loss of use. A straightforward reading exercise, but a good reminder of how often this coverage is missing or set at a very low limit. Question 4. This is the most important question. If the dwelling limit is below true rebuild cost today, the recommendation should include updating both the homeowner's dwelling limit and the earthquake dwelling limit together. Reinforce the link between the 2 policies. Debrief as a group. Encourage agents to walk through their reasoning, not just give answers. Great work getting through Earthquake Insurance 101. You now know what earthquake insurance is and why it's critical in California, the three coverages and how to set them, the key terms clients will ask about, how policies are rated, and the common myths you will need to address in every homeowner's conversation. Remember, earthquake insurance is not a nice to have in California. It is a conversation you should have with every single homeowner and condo owner you talk to. Not having it is the risk, not the premium. Next up, personal umbrella policy 101.